New York City's Stern Stewart and Company uses a totally different system based on economic principles rather than accounting principles to determine a company's value. The theory he and his partner Bennett Stewart created focuses on how companies can create wealth with their capital, thus increasing the shareholders' value. Whether or not wealth is created or destroyed is based upon the decisions management make for the company. Mr. Stern has very definite ideas about how companies should be evaluated.
And that is that the value of a company is really based on just two things. One is how well it is expected to perform, that is the magnitude of returns that will be generated in the future. And the second thing should be the required rate of return based on the risk in achieving the returns. So you've got risk and reward, essentially, in that model.
Although Stern Stewart's theory of evaluation is catching on in big business, it eschews some of the widely accepted accounting standards that businesses and investors have relied upon for so long.
The problem is that the accountants who take a look at value in terms of the accounting bottom line. They call it net profit after taxes, earnings attributable to the shareholders. We don't look at it that way. First of all, as economists, we look at value in terms at least of cash flows as opposed to accounting earnings. And the major reason is that the accountants, unfortunately, are focusing on arbitrary distinctions that don't necessarily reflect on economic reality. An example of that would be the expensing of research and development costs or the immediate write-off of advertising and promotion. We believe that they have long-term franchise value and that they should be put on the balance sheet as assets.
As it turns out, there are about 160 adjustments in general accounting practices that can be made, depending on the client. Once the adjustments have been made, the book value of the company changes to more accurately reflect the economic value of the company.
Now keep in mind, as I said before, that we're making adjustments to the accounting book value to make it more economically realistic by putting the R&D on the balance sheet and writing it off over the expected useful life. There are many such accounting adjustments that are possible. So let's call the item we come up with the adjusted book value. What we're looking at is the value that is created in the firm above that figure. Now we call that premium value market value added, MVA, market value added. Some of us even call it management value added. It's the value that has been created because of the quality of management to earn superior rates of return above the required return for risk.
Market value added is defined mathematically as the market value of the company, calculated as the market value of equity plus the book value of debt, minus all of the capital investors have provided, including loans, retained earnings, and paid-in capital. More simply put, MVA is the difference between what investors have put into the company and what they could get for the company if they sold the company in today's market. Hopefully that number is positive, which would indicate that the management has increased the value of its capital, thus creating shareholder wealth. MVA can be negative, however, suggesting that management has destroyed shareholder wealth.
It turns out that that MVA is of very great importance to shareholders because it represents premium value created. But the problem is you cannot use it as a basic concept in valuation, because it only measures the value at the consolidated level of the company. If you want to go down deep into a company to find out what caused the value to take place, you need to have a measure of performance for the operations of the firm. And that operating measure of performance we call EVA, economic value added.
Economic value added is defined as net operating profit after tax, minus the opportunity cost of all capital invested in the company. Because EVA is based on net profit, and not a market valuation like MVA, EVA measures the performance of the company itself during the period in which it was measured. Unlike EVA, which is solely an internal evaluation of a company's performance in a certain period, MVA, which is based on a company's market value, is affected by the external forces of the marketplace. For example, 75% of a company's market value is determined by factors unrelated to the company's performance. The general state of the world, interest rates, inflation, economic expectations, and industry conditions all factor into the market value of a company.
So it is possible that market value and thus MVA is the result of all kinds of factors that are not just driven by the company's own performance. And the question is, to what extent do you want to use tools that are based on factors that are so, at times, unrelated to what the company is about? That's also one of the major advantages, then, of looking at EVA. MVA, the market value added based on the market value of the company, is a function of all of these extraneous issues. That's 75% that has maybe nothing to do with the company, okay? EVA, on the other hand, is a direct operating measure. And that's why it is so helpful to use EVA rather than MVA as a basis for measuring management's real performance, because it essentially is insulated from all of these non-company specific factors.